The stock market just hit all-time highs, and everyone thinks the tariff crisis is over. But what if I told you the April crash that wiped out 6.6 trillion was just the warm-up, and the real devastation is coming in 2026? Here's what nobody's connecting. Yes, Trump's Liberation Day tariffs on April 2nd triggered the worst two-day market loss in history. The S&P 500 dropped 10%. The Dow lost over 4,000 points. 6.6 trillion vanished in 48 hours, but then Trump delayed the worst tariffs. Markets recovered, and by June 27th, we hit new all-time highs. Wall Street thinks it's over. They're celebrating. They're saying Trump always chickens out. But here's what they're missing. The New York Federal Reserve just published a comprehensive study analyzing Trump's 2018-2019 China tariffs. What they found should terrify every investor. Companies exposed to those tariffs saw productivity drop 2.2%, employment fall 3.9%, sales decline 6.7%, and profits collapse 12.9%. And these effects lasted through 2021. 3 years of damage from tariffs that were far narrower than what we have now. And get this, the current tariff rate is 16.8%, the highest in 90 years. It's never increased this fast in American history. And unlike 2018 when tariffs only hit China, Trump's 25 tariffs hit everyone, every country, every sector. In this video, I'm exposing the 4 reasons why Trump's tariffs are a ticking time bomb that will crash markets in 2026, why the April crash was just the preview, and exactly what you need to do before corporate earnings reveal the true damage. But there's one legal issue about Trump's tariffs that is by far the most dangerous for markets, and yet almost nobody is paying attention to it. It's the Supreme Court case. And if the court rules against Trump, the financial consequences could trigger a bigger crash than April. Here's the background. Trump justified most of his tariffs using something called the International Emergency Economic Powers Act, IEEPA. This is a 1977 law that gives the president emergency powers during national security crises. The problem? IEEPA never explicitly gives the president the power to impose tariffs. In fact, the law never even mentions the word tariffs. Trump declared that America's trade deficit was a national emergency and used that as justification to impose duties on virtually all imports. And in May 2025, the Court of International Trade ruled that Trump exceeded his authority. The IEEPA tariffs are illegal. Now the case is headed to the Supreme Court. And here's where it gets scary for markets. The government has already collected about $90 billion in revenue under the IEEPA tariffs through September 2025. If the Supreme Court determines Trump exceeded his authority, that money would likely have to be refunded. Think about what that means. The government didn't plan for this expense. They already spent that money. So where did they get $90 billion to refund companies? They'd have to borrow it by issuing Treasury bonds. But bond investors are already concerned about growing federal debt, which was supposed to be reduced by tariff revenue. If the government suddenly has to borrow $90 billion to refund tariffs, bond investors will demand higher interest rates to offset the risk. Higher bond yields mean higher borrowing costs for everyone: mortgages, car loans, business loans, everything. And higher yields make stocks less attractive compared to bonds, triggering selling pressure. But it gets worse. Companies like Costco are already filing lawsuits to ensure they get reimbursed. The New York Times reports there's a growing list of U.S. companies submitting claims. These aren't just small businesses. These are major corporations with armies of lawyers who know the tariffs were illegal and want their money back. Treasury Secretary Scott Bessent recently said that the Supreme Court rejecting Trump's tariffs would be a loss for the American people. But that comment contradicts the data. Since Trump began imposing tariffs, Hiring has slowed, unemployment has increased, manufacturing activity has declined, and consumer sentiment has plunged to the lowest level in history. The University of Michigan's Index of Consumer Sentiment averaged 57.6 in 2025, the lowest annual average ever recorded, lower than 2008, lower than COVID, lower than any recession in history. If the Supreme Court strikes down the tariffs, companies get refunds, prices come down, consumers benefit, and the economy improves. That should be good for stocks, right? But here's the catch. The initial shock of the government needing to borrow $90 billion combined with the uncertainty about which tariffs are legal and which aren't would create chaos in markets. And chaos triggers selling, especially when stocks are already trading at historic valuations. The Supreme Court case is a loaded gun pointed at the market, and nobody knows when it fires. But even if the Supreme Court upholds the tariffs, there's a corporate earnings disaster brewing. This next economic reality is perhaps the most devastating for stock prices, and it comes from a comprehensive analysis by the New York Federal Reserve that nobody's talking about. It's the lasting damage to corporate profits. And the historical data proves this crash isn't over, it's just getting started. Let me walk you through the study. 4 economists from the New York Fed analyzed Trump's China tariffs from 2018 and 2019 to see what impact they had on American companies. They published their findings on Liberty Street Economics, and the results are brutal. Companies exposed to Trump's tariffs experienced average declines of 2.2% in labor productivity, 3.9% in employment, 6.7% in sales, and 12.9% in profits between 2019 and 2021. Read that again. Profits dropped 12.9%, and the effects lasted 3 years. Now here's why this matters for 2025 to 2026. Those were tariffs that only targeted China and covered a fraction of imports. Trump's current tariffs are exponentially broader. They hit every country with at least a 10% baseline tariff, plus reciprocal tariffs that go much higher. The average U.S. tariff rate has gone from 2.5% to 16.8%, the highest in 90 years. According to Yale's Budget Lab, it has never increased this quickly in American history. And these aren't just tariffs on finished goods. These are input tariffs. Duties on copper, steel, aluminum, automotive parts, and raw materials that American manufacturers need to make products. When those costs go up, one of 2 things happens. Either companies absorb the costs and profits shrink, or they pass costs to consumers and demand falls. Either way, corporate earnings get crushed. The New York Fed study explains exactly why this happens. Input tariffs drive up domestic production costs. Those costs get passed to consumers through higher prices. But consumers have limited budgets. When prices rise, they buy less. When they buy less, corporate sales fall. And when sales fall, profits collapse. We're already seeing this play out. GDP contracted 0.3% in Q1 2025, the first economic contraction since Q1 2022. The economy went from 2.4% growth in Q4 2024 to shrinking in Q1 2025. That's not a soft landing. That's the brakes slamming. Manufacturing activity has declined. Job creation has slowed. Only 73,000 jobs added in July, far below expectations. Unemployment is rising, and consumer sentiment is at the lowest level ever recorded. But here's the key point. Corporate earnings reports lag the real economy by about 2 quarters. Companies report based on the previous quarter's performance. So the full impact of tariffs won't show up in earnings until late 2025 and into 2026. That's when investors get the shock. Earnings estimates get slashed, guidance gets cut, profit margins compress, and suddenly the stock market's valuation looks insane. Right now, the S&P 500 is trading at premium valuations despite all these headwinds. If earnings drop even 10% from current levels and the market re-rates to reflect that decline, you're looking at a 30% stock crash. Remember, stocks don't just trade on earnings. They trade on earnings growth expectations. If Wall Street expects 10% earnings growth and gets 10% instead, that's a 20-point miss. The market doesn't just drop to reflect lower earnings. It overshoots on the downside because expectations were so wrong. The April crash happened because markets were shocked by the tariff announcement. They priced in immediate fear and uncertainty. But then Trump delayed the worst tariffs and markets recovered. Now those delayed tariffs are in effect. Companies are dealing with the reality. And the earnings damage is accumulating every day. We just won't see it in the numbers until Q4 2025 and Q1 2026 reports come out. That's when the real crash happens. Not from tariff announcements, from actual earnings collapses, proving the New York Fed study was right all along. And there's one more factor that makes this crash inevitable: the valuation trap. Here's the market condition that guarantees a crash when earnings decline, and it's hiding in plain sight. It's the valuation problem. And when you understand how overpriced stocks are right now, you'll realize why even a small earnings miss triggers a massive sell-off. Let me explain how market crashes actually work. They're not usually caused by one event. They're caused by overvaluation meeting disappointment. In 2000, the dot-com bubble burst not because the internet was bad. It was because valuations were insane, and earnings couldn't justify the prices. In 2008, the housing crash happened because subprime mortgages were overvalued, and defaults revealed the truth. Right now, stocks are expensive by almost every measure. The S&P 500 hit all-time highs in June 2025. Even though GDP contracted in Q1, consumer sentiment is at record lows, and corporate profits are under pressure from tariffs. How is that possible? Because investors are betting on future earnings growth. They're paying premium prices today based on the assumption that earnings will grow 10–15% per year for the next few years. But the New York Fed study proves that's not going to happen. Earnings are going to shrink, not grow. And here's the math that terrifies me. If the S&P 500 peaked at 6,144 in February 2025, and the historical average decline during recessions is 31%, that puts the index at 4,239. From current levels around 5,500, that's 23% downside. But that assumes a typical recession. If tariffs cause a worse than average recession, which is very possible given how fast they were implemented and how broad they are, the decline could be steeper. Analysts are already pricing in recession risk. A Wall Street Journal survey shows 45% probability of recession in the next 12 months, up from 22% in January. Goldman Sachs raised their recession odds from 15% to 20%. JP Morgan raised theirs from 30% to 40%. But markets haven't priced this in yet. Why? Because earnings haven't confirmed it yet. Once Q4 2025 and Q1 2026 earnings reports start showing the damage, that's when reality hits. And remember, the current tariff rate of 16.8% is still in effect. Companies are paying these higher costs right now. They're dealing with disrupted supply chains right now. They're seeing consumer demand weaken right now. The August jobs report showed only 73,000 jobs created, far below the 150,000 expected. That's a sign the labor market is weakening, and labor market weakness leads to less consumer spending, which leads to lower corporate revenue, which leads to falling profits. It all connects. Citi analysts recently cut their recommendation for U.S. stocks from overweight to neutral, saying the U.S. economy may no longer outpace the rest of the world. That's a huge shift. The entire rally from 2020–2024 was built on the idea that America had economic exceptionalism. If that's gone, there's no reason for stocks to trade at premium valuations. And here's what really scares me. Markets recovered from the April crash because Trump delayed tariffs. Investors learned that when things get bad enough, Trump backs down. But what happens when earnings collapse and Trump can't back down because the tariffs are already in effect? What happens when the damage is already done and delaying more tariffs doesn't help? That's when you get capitulation. That's when investors realize the Fed can't fix this with rate cuts. That's when the real crash happens. So what should you do right now to protect yourself? Here's exactly what you need to do right now if you have money in the stock market. Step 1. Reduce your stock exposure. If more than 70% of your portfolio is in stocks, you're overexposed. With recession odds at 45% and corporate earnings about to show tariff damage, you need to de-risk. Move 10–20% of your stock holdings into cash or short-term Treasury bonds. You don't have to sell everything. You're not trying to time the bottom. You're just reducing exposure so a 30% crash doesn't destroy your portfolio. Step 2. Avoid companies with tariff exposure. Any company that imports goods or raw materials from overseas is at risk. That includes most retailers, Walmart, Target, Amazon, Best Buy. It includes automakers, Ford, GM. It includes tech companies that manufacture overseas, Apple. If you're holding these stocks, consider reducing your positions. The earnings hits are coming. Step 3. Focus on defensive sectors. Consumer staples, utilities, and healthcare tend to hold up better in recessions. Companies like Procter & Gamble, Johnson & Johnson, and NextEra Energy don't rely on economic growth to make money. People still need food, electricity, and medicine even in downturns. Step 4. Build your cash position. This is critical. If markets do crash 20–30%, you want cash ready to buy great companies at discount prices. Warren Buffett is holding $325 billion in cash right now, the highest ever. He's waiting for a crash. You should do the same on your scale. Keep 20–30% of your investable assets in cash or money market funds, paying 4.5 to 5%. You're not losing to inflation when stocks drop 25%. Step 5. Watch the earnings calendar. Q4 2025 and Q1 2026 earnings season is when the truth comes out. If companies start missing estimates and cutting guidance, that's your signal that the New York Fed study is playing out in real time. Don't wait for the crash to happen. By the time earnings confirm the damage, stocks will already be down 15–20%. Step 6. Ignore the noise. Trump will tweet that everything is fine. Treasury Secretary Bessent will say there's no recession coming. Economic advisors will claim tariffs are working. Ignore it. Look at the data. GDP contracted. Jobs growth slowed. Consumer sentiment at record lows. Corporate profits are going to fall. That's not opinion, that's math. So we've covered the 4 reasons why Trump's tariffs are a ticking time bomb for markets. The Supreme Court case that could force $90 billion in refunds and create a Treasury bond crisis. The New York Fed study proving tariffs cause lasting damage to corporate earnings. The valuation trap that guarantees a crash when disappointing earnings meet overpriced stocks. And exactly what you need to do right now to protect your portfolio. These are the warning signs smart investors are watching, while Wall Street celebrates new highs. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know which sectors and stocks will survive the crash and which ones will be destroyed. Without knowing where to position your money for the recovery, you'll miss the best buying opportunity in years. Click this video over here where I break down the recession-proof stocks to buy and exactly when to buy them. I'll see you in the next one.